Typically, holding a position over earnings is extremely risky. I mean, it really pretty much comes down to a coin toss. You have no idea what the earnings are going to be. You have no idea what the guidance is going to be. And you really don't even know how the market's going to react to the earnings report. However, there is one method using options that you can use to profit off the volatility crush that occurs after an earnings announcement. So stick around after the intro and we'll show you how to set up an Iron Condor option trade, which is perfect for profiting off earnings announcements. All right, so what is an Iron Condor and how do you set it up? So I will say this is more of an advanced option strategy consisting of two simpler option strategies, that being the bear call spread and the bull put spread. Now, if you're not familiar with what those are, I did do a previous video where I went into a lot of detail explaining how to set up each one of those spreads. So I'll post a link here in the video if you want to check that one out. But basically, an Iron Condor is saying that you believe the stock price is going to trade sideways, at least in the short term, and you believe the price is going to stay somewhere in between your short call and your short put. So basically you collect premium by putting this trade on and you profit when your options expire worthless. So the nice thing about this trade is as soon as you put it on, you know exactly what your profit potential is and you know your maximum risk. So your profit potential is simply the premium you collected. That's the most you can make on this trade. Your risk on this trade, your maximum risk, is simply the width of the spread minus the premium you collected. So now let's go over an example of a trade that I just put on last week. So this is a trade that I put on Shopify, ticker SHOP. So I put this trade on May 3rd, and they were expected to report earnings before the open on May 4th. Now, one thing to note is whenever you're putting on this kind of trade, if your purpose of the Iron Condor is for the volatility crush that occurs over earnings, you want to put it as close to the earnings date as possible. So in other words, you don't want to put this trade on a week or two prior to earnings. I mean, 2 to 3 days max prior to earnings. I like to do it, right the day before. And when you're choosing the expiry date for the Iron Condor, I like to go about 1 week past the earnings date. And the reason I like to do that, it'll become pretty clear later in the video, but it gives you a little bit of flexibility in case if the trade does go against you. Having that 1 week window allows you to manage the trade and maybe mitigate your losses, or even in some cases turn losses into profits. So let's look at the chart and I'll show you how I set this trade up. So the first thing I want to show you is if we look at the implied volatility, so that's these blue dots that are overlaid over the volume. The implied volatility, you can see pretty clearly that right before earnings, so here was an earnings date, right before earnings, you get this big spike in volatility. And as soon as you get the earnings date pass, the volatility just gets crushed. So that's the same thing we're expecting here. The volatility stayed pretty low. Couple weeks before the earnings date, it starts to spike up. And you see, our peak volatility is right here on the day before earnings. So that's when you would get the most premium for the options that you sell. And that's really the reason why I like to do it as close to the earnings date as possible. So now we would expect right after earnings, the volatility would get crushed on the following day. Now, you don't really need to have the implied volatility on your chart. I like to have it, just for other trades that I put on. For the Iron Condor, you really don't need it because all you need to know is that implied volatility goes up prior to earnings and it crushes after earnings. Now, looking at the chart, we can see that, it had a really nice rally earlier in the year. And since then, it's kind of been consolidating. So the way I set this trade up, first let's look at the bull put spread. So I sold the May 12th $42 put. So $42, that's right around here. And then as protection, I bought the May 12th $39 put. So if we look at $39, that's right around here. Now on the flip side, so on the top side of this price range, the bear call spread, I sold the May 12th $53 call. So if we look at $53, that puts us right around over here. And then again, for protection, I bought the May 12th $56 call. So 56 puts us right around there. All right, so let me just make sure that everyone is really clear on this because this is really important. So basically, this line and this line represent our short call and our short put. So ideally, at time of expiry, we want the price to stay within this box. If the price stays within this box, that gives us our maximum profit because all our options will expire worthless. Now, between that box and the outside lines, both on the top and the bottom, that's where your profits start to deteriorate quite rapidly. And your maximum loss occurs at these outside lines. So basically anything at or outside of those lines, you'd be at your max loss. So for example, it doesn't matter if the stock gets to $39 or if it goes to $30. You still have the same maximum risk or the same maximum loss on this trade. All right, so now you're probably wondering, well, how did I pick these strike prices? Well, for one thing, you can see the price is centered between these strikes. Obviously, that's important because we don't know which way the price is going to move after earnings. Now, in order to pick your strikes, you really need to know what the expected move is. Now, that's a whole separate topic that really is too much for this video. Maybe I should do a separate video just on expected moves. But if you look it up, I mean, there's tons of information online. If you just search for expected moves, basically it's a calculation that uses the option prices and option activity to try and predict what is the maximum possible move after the earnings. So in this case, I'll just tell you that when I put this trade on, the expected move was $4.61. And also when I put the trade on, the stock price was at $47.40. So now using that information, that gives us a range of $42.79 on the low end and $52.01 on the upper end. So once you know kind of what your expected range is, what you want to do is you want to pick your short call and your short put so it's just slightly outside of that range. So you can see in this example, that's exactly what I did with the $42 put and the $53 call. Now for this Iron Condor, when I put the trade on, I received 84 cents in premium. So again, that's the maximum profit that I can make if the stock stays between my short put and my short call. Now to calculate your maximum risk on the trade, again, it's just the width of the spread minus the premium you received. So each one of our spreads, and that's the other thing, you want to make sure that each spread is the same width. So the width of our spread is $3 and minus the 84 cents we collected. So that gives us a maximum risk of $2.16. So obviously you notice that your dollar value of risk is quite a bit higher than your dollar value of reward. Well, the reason for that is our strike prices, our short strike prices that we selected, both for the call and the put, are way out of the money. And because of that, this trade has a really high probability of success. So to offset that high probability of success, that's the reason why your dollar value of risk is higher than your dollar value of reward. So now once you're in the trade, basically you just wait for the volatility crush to happen, the next day after the earnings are announced. And at that point, you can either close out your trade for a really nice gain, or depending on how the stock is behaving, hold it till expiry and keep the entire premium. Now, brace yourself for this next part. This is going to be incredibly unique. Most traders only talk about their winning trades. So when you watch videos like this, or you're talking to traders, they only show you examples of trades that they put on that were successful. Well, in this case, this trade that I'm using as an example was not successful. I actually ended up losing money on this trade. Now, the reason that I picked this trade to use as an example is, look, not every trade is going to be a winner. No matter what strategy you use, you're never going to have a 100% success rate. So I think it's really important to show you what can happen when you put this kind of trade on, what some of your risks are, but more importantly, how to mitigate those. So when this particular type of trade goes against you, there are some steps that you can take to manage the trade and further reduce your risk. So in other words, we started off with a maximum possible loss of $2.16. Well, there are some things you can do after the earnings report, and this is why, again, I like to have that 1 week window. There's some things you can do to actually reduce that to even less. So let's go back to the chart and I'll show you what happened after earnings. And there we go. So you can see that the stock gapped way up, huge volume, incredible volume. So they reported earnings way better than expected. And I think it was mostly their guidance was way better than the market expected. And the stock had a huge gap up and continued to run throughout the day. We can see the stock closed up $11 on the day. So much for that $4 expected move. And that does happen. I mean, that's trading. Nothing is guaranteed in trading. So we had this huge move up, and our issue is that the stock not only got outside of this gray box, but it's outside of our top bar. So it's probably, this is pretty much a worst case scenario. Can't get much worse than this. Because like I said, once you're outside that top line, really doesn't matter how much farther it goes. It's still the same maximum loss. So when this happens, there's a couple things you can do. The first is you can roll your unaffected spread towards the price. Now you keep the same expiry date. All you do is you change the strike prices. What this does is it allows you to collect additional premium. It changes your range, so now you have a new range that you want the stock to stay within, but it gives you some extra premium to collect, and that lowers basically your maximum loss. Now, this method works really good if you're in a loss position, but if the price is not completely outside of the affected spread. So let's say, for example, if this had gapped up and let's say it was somewhere in between these two lines. This method works really good because it allows you to collect some more premium, but it puts you in a position where if the stock does pull back, it still gives you a chance to actually turn this into a profitable trade. Now, in our case, like I said, this is pretty much a worst case scenario because we're now outside the line. So I actually looked at this and I mean, it was only going to give me like an extra 10 cents. So it really wasn't going to help much with this trade. So the second option, what you can do, and this is one that works much better for when the stock is out here, at a worst case scenario. And that is you essentially convert your Iron Condor into an Iron Fly or an Iron Butterfly. And so to do this, you basically roll the unaffected spread, but you roll it up all the way to your short call strike. So in this case, our short call strike is up here at $53. So what you do is you roll the $42 short put all the way up to $53. And then you buy a $50 put as protection. So now that your short call and your short put are at the same price, you really don't have much of a window of profitability. And in this case, I'm not really expecting to turn this into a profit. I think the chances of this pulling back down, to $53 or somewhere where I'd be profitable is extremely slim. At this point, I'm not trying to make a profit. I'm trying to limit my losses. So that's exactly what this strategy does of converting to an Iron Fly. It gives you the maximum amount of premium or the maximum amount of additional premium that you can collect by doing this roll. But like I said, it really limits your chances of turning this into a profit. So when I did this roll, and again, it's important to keep the same expiry date. So when I rolled this up, I collected an additional 32 cents in premium. So now that brings the total premium collected to the 86 cents from the original trade, plus the 32 cents I collected on the roll. So that brings a total premium of $1.18. So now, given that premium collected, our maximum possible loss has reduced. It's now $3 minus the $1.18, which is $1.82. So now the most we can lose is $1.82, and that's a lot better than $2.16. Now, one more thing you can do. So when you hold this, so now you got to hold this one extra week, right? So you got to hold this, at least close until May 12th. What you want to do on either May 11th or May 12th, you want to take a look at this trade again. And if the stock has pretty much just traded sideways up at this level, or even better, if it's pulled back, say to around $53, $54, somewhere near our strikes. One other option that you can do is you can actually roll the entire thing using the same strikes. So basically you'd roll your Iron Fly one more week out in time. And what that's going to do is, again, you're probably not going to become profitable, but what that'll do is it'll collect additional premium for you again, probably an additional 30 cents or so, and it'll further reduce your loss. So now, instead of a loss of 180, maybe you'll only have a loss of, say 150, for example. Now, the only caveat to that is you'll have to see if it's worth it for you at that time, because you got to remember, if you were to just take this loss, book the $1.82 loss, and then take your money and put it in a different stock where you can actually make a profit that week, that might be more beneficial than, trying to save an additional 30 cents on this trade. Again, that'll depend on how many Iron Condors you sold and what that total dollar value is, for that 30 cents that you can save. But it's something you'll have to look at, just the opportunity cost of the money that you have. You're going to be tying up money, you're going to be tying up your margin. Is there somewhere better you could put it where you'd make more? Or is it worth it to roll out and hold it for one more week to recover some more of those losses? All right, well, that's all we got on this video for Iron Condors. Hopefully that helps you to understand on how to set up an Iron Condor trade, how to use it to trade the volatility crush that comes along with earnings, but most importantly, how to manage the trade when it does go against you. Because, like I said, you are going to have trades that don't succeed. That's just trading. And it's really important to know what to do, not to panic, but how to manage a trade when it goes against you. Try and recover some of your losses. Or like I said, in some cases, you can even turn, losing trade into a profitable trade by making some of these simple adjustments, depending how much the stock moved against you. So Hopefully that helps. And if you're enjoying our videos, please hit the like and subscribe buttons. It really helps us out a lot. And we'll see you next time.